Good morning. Namaskar. We are now into the 8th year of our monetary policy making under the new inflation targeting framework. If you remember, this was started in October of 2016. So 7 years are complete. We are into the 8th year. And on a personal note, if I can seek your indulgence, this would be my 32nd monetary policy, including the off-cycle meeting last year and a special meeting. And at the outset, let me also wish each one of you a very happy new year in advance. And this is how the statement reads. As 2023 comes to an end and a new year begins, the long-awaited normality still eludes global economy. The years 2020 to 2023 will perhaps go down in history as the period of great volatility, comprising a host of black swan events in quick succession. The global economy is showing signs of slowdown, though unevenly across geographies and sectors. The emerging market economies, that is EMEs, as a group have remained resilient during the current bout of volatility, unlike previous episodes. While headline inflation has receded from the highs of last year, it remains above target in many countries. Core inflation continues to be sticky, impeding the last mile of disinflation. Major central banks have kept rates on hold while refraining from forward guidance in view of the prevailing uncertainties. Financial markets remain volatile in their quest for definitive signals about the future path of interest rates. Against this unsettled global environment, the Indian economy presents a picture of resilience and momentum. The real gross domestic product, that is GDP growth for Q2 of the current financial year, has exceeded all forecasts. The fundamentals of the Indian economy remain strong, with banks and corporates showing healthier balance sheets, fiscal consolidation on course, external balance remaining eminently manageable, the forex reserves providing cushion against external shocks. These factors, combined with consumer and business optimism, create congenial conditions for sustained growth of the Indian economy. Looking ahead, it is our endeavor to further build on these fundamentals, which are the best buffer against global supply shocks in today's uncertain world. Let me now turn to the decisions and the deliberations of the Monetary Policy Committee, which was held, as you know, on 6th, 7th, and today 8th of December. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, of course, the Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. Since the last policy, CPI headline inflation moderated to 4.9% in October from 7.4% in July. The moderation was observed in all components of CPI, namely food, fuel, and core, that is CPI excluding food and fuel. There has been broad-based easing in core inflation, which is indicative of successful disinflation through monetary policy actions. The near-term outlook, however, is masked by risks to food inflation, which might lead to an inflation uptick in November and possibly in December. This needs to be watched for second-round effects, if any. Domestic economic activity is holding up well as assessed in the previous MPC meetings and as reflected in the GDP growth for the second quarter of this year. Against this backdrop, the MPC decided to keep the policy repo rate unchanged at 6.5%, but remain highly alert and prepared to undertake appropriate policy actions as warranted. Monetary policy must continue to be actively disinflationary to ensure fuller transmission and anchoring of inflation expectations. The rate action so far is still working its way into the economy. Hence, the MPC decided to remain focused on withdrawal of accommodation to ensure that, as I have already stated, to ensure that inflation progressively aligns to the target while supporting growth. I would now like to provide an assessment of the growth and the inflation situation. First, let me focus on global growth in brief. The global economy continues to remain fragile. World trade is decelerating amidst global tide of protectionism. Despite significant restoration of global supply chains, factors like elevated debt levels, lingering geopolitical hostilities, and extreme weather conditions aggravate the risks to global growth and inflation outlook. Easing of inflation in advanced economies has led to expectations of an early end to the monetary policy tightening cycle, shoring up market sentiments. Sovereign bond yields are softening as markets are not factoring in any further rate hikes. Coming to domestic growth, economic activity in India exhibited buoyancy in the second quarter of this year, aided by strong domestic demand. GDP growth, as you would know, posted a robust growth of 7.6% in the second quarter of this year, that is 2023-24, driven largely by investment and government consumption. Turning to the third quarter, two-thirds of Rabi sowing has been completed despite late harvest of Kharif crops in some states. Manufacturing sector gained strength with easing input cost pressures and pickup in demand conditions. 8 core industries recorded healthy growth in October and continued their high growth since June this year. The Purchasing Managers Index, that is the PMI for manufacturing, rose in November. The services sector buoyancy has remained intact as reflected in the high frequency indicators which the Reserve Bank monitors. GST collections at rupees 1.68 lakh crore in November 2023 were also buoyant. Services PMI displayed healthy expansion in November. In my statement, there is a lot of data available which I have put in the footnote. So those of you who are interested can have a look at the footnotes. The entire data in support of whatever I am saying is available in the footnotes. On the demand side, households' consumption is supported by durable urban demand and gradual turnaround in rural demand as reflected in sales of fast-moving consumer goods, that is FMCG, and other indicators. Festival-related demand is also spurring household discretionary consumption in the third quarter, that is in the current quarter. Investment activity continues to be aided by buoyancy in public sector capex. This is also reflected in strong growth in steel consumption, cement production, and imports of capital goods. Capacity utilization in the manufacturing sector continues to remain above the long period average. Investments in fixed assets by listed private sector manufacturing companies also registered healthy growth in the first half of 23-24, primarily driven by key industries such as petroleum, steel, chemicals, and cement. The total flow of resources to the commercial sector from banks and other sources at rupees 17.6 lakh crore during the current financial year so far is significantly higher than that of last year, which was at rupees 14.5 lakh crore. Despite weaknesses in external demand, both goods and services exports returned to positive territory during the month of October this year. Looking ahead, private consumption should gain support from gradual improvement in rural demand, strengthening of manufacturing activity, and continued buoyancy in services. The healthy twin balance sheets of banks and corporates, high capacity utilization, continuing business optimism, and government's thrust on infrastructure spending should propel private sector capex. The drag from external demand is also expected to moderate with a turnaround in merchandise and services exports. The protracted geopolitical turmoil, volatility in global financial markets, and growing geoeconomic fragmentations, however, pose risks to the outlook. Now, taking all these factors into consideration, real GDP growth for the current year, that is 2023-24, is projected at 7%. I repeat, real GDP growth is projected at 7% for the current year, with the third quarter at 6.5% and the fourth quarter at 6%. Real GDP growth for next year, and we have provided the figures for the first three quarters of next year. So real GDP growth for the first quarter of 24-25 is projected at 6.7%, for Q2 at 6.5%, and Q3 at 6.4%. The risks are evenly balanced. I would now like to turn to inflation. Food inflation, which was in double digits in July, has since then moderated to 6.2% in October, with correction in vegetable prices. Fuel inflation slipped into deflation since September, primarily reflecting the sharp fall in LPG prices in end August. The disinflation in core gathered momentum during September-October and reached levels last seen in the fourth quarter of 2019-20 due to the combined effect of policy rate increases and reduction in cost push pressures across core goods and services. Going ahead, inflation outlook would be considerably influenced by uncertain food prices. High-frequency food price indicators point to an increase in prices of key vegetables, which may push CPI inflation higher in the near term. The ongoing Rabi sowing progress for key crops like wheat, spices, and pulses needs to be closely monitored. Elevated global sugar prices is also a matter of concern. On the positive side, global commodity prices, particularly agricultural commodities, have softened except rice. For highly import-dependent food items like edible oils, international prices continue to remain soft. Domestic milk prices have stabilized. Proactive supply-side interventions by the government are also containing domestic food price pressures. Crude oil has softened considerably, though it may remain volatile. Taking into account these factors and on the assumption of normal monsoons, CPI inflation is projected at 5.4% for the current year, that is 2023-24, with the third quarter at 5.6% and the fourth quarter at 5.2%. CPI inflation, and here again we are giving for the first three quarters of next year, CPI inflation for the Q1 24-25 is projected at 5.2%, Q2 at 4%, and Q3 at 4.7%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? Let me provide our assessment. We have made significant progress in bringing down inflation to below 5% in October 2023, despite occasional blips due to intermittent supply shocks. The summer of 2022 is behind us. Our policy of prioritizing inflation over growth, hiking the interest rates, that is policy rate, by 250 basis points in a calibrated manner, and draining out excess liquidity have worked well, alongside supply-side measures taken by the government to bring about this disinflation. The fact that core inflation has also trended lower and household inflation expectations have become better anchored gives us the confidence and conviction that monetary policy is doing its job. On the other hand, growth remains resilient and robust, surprising everyone on the upside. Notwithstanding this progress, the target of 4% CPI is yet to be reached, and we have to stay the course. Headline inflation continues to be volatile due to multiple supply-side shocks, which have become more frequent and intense. The trajectory of food inflation needs to be closely monitored. Intermittent vegetable price shocks could once again push up the headline inflation in November and, as I said, possibly December. While monetary policy would look through such one-off shocks, monetary policy has to stay alert to the risk of such shocks becoming generalized and derailing the ongoing disinflation process. In the midst of these uncertainties, monetary policy has to remain actively disinflationary to ensure a durable alignment of headline inflation to the target rate of 4% while supporting growth. I would now like to focus on the liquidity and financial market conditions. Like most other central banks, the Reserve Bank had injected additional liquidity into the system to counter the COVID-related onslaught on our economy. Consequently, the size of the Reserve Bank's balance sheet had expanded significantly. Persistence of such expanded balance sheet far too long could have created macroeconomic and financial instability. It is worth noting that the Reserve Bank has successfully reduced its balance sheet size well in time. Illustratively, the size of Reserve Bank's balance sheet swelled to 28.6% of GDP in 2020-21. With modulation in liquidity in the post-COVID period, the balance sheet size moderated to 23.3% of GDP in 2022-23 and further to 21.6% in the current financial year up to December 1. We consider this as a significant achievement. System liquidity, as measured by net position under the Liquidity Adjustment Facility, that is LAF, turned into deficit mode for the first time in September this year, after a gap of nearly 4.5 years since May 2019. Deficit liquidity conditions persisted during October and November, prompting large recourse to marginal standing facility, that is MSF, by the banks. In parallel, utilization of standing deposit facility, that is SDF, has also been high. The overall tightening of liquidity conditions is attributed mainly to higher currency leakage during the festive season, government cash balances, and Reserve Bank's market operations. Driven by these autonomous factors, system liquidity tightened significantly compared to what was envisaged in the October policy statement. Consequently, the need to undertake auction of OMO sales has not arisen so far. The evolution of liquidity conditions has been in alignment with the monetary policy stance. More recently, however, as government spending has picked up and system liquidity has got more evenly balanced among market participants, pressures have eased and the net LAF position has evened out broadly. Going forward, government spending is likely to further ease liquidity conditions. On our part, the Reserve Bank will remain nimble in liquidity management. Now, different segments of the financial markets have witnessed monetary transmission of varying extent. Long-term G-Sec yields have softened, reflecting strong demand for these bonds from financial institutions and softening of global bond yields. In the credit market, monetary policy transmission is still working its way through the system, and the supporting data is provided in the footnote. With regard to standing facilities of the Reserve Bank under the LAF, we have noticed, as I pointed out, we have noticed simultaneous high utilization of both MSF and SDF by the banks. This was also pointed out by me in the last monetary policy statement. We propose to address this situation and have therefore decided to allow reversal of liquidity facilities under both SDF and MSF even during weekends and holidays with effect from December 30, 2023. This is an important announcement so far as the banks and the liquidity situation is concerned. So let me just read it again. We have decided to allow reversal of liquidity facilities under both SDF and MSF even during weekends and holidays with effect from December 30 this year, that is December 30, 2023. It is expected that this measure will facilitate better fund management by the banks. This measure will be reviewed after 6 months or earlier if needed. The Indian rupee has exhibited low volatility compared to its EME peers in the calendar year 2023, despite elevated US Treasury yields and a stronger US dollar. The relative stability of the Indian rupee reflects the improving macroeconomic fundamentals of the Indian economy and its resilience in the face of formidable global tsunamis. Recently, the Reserve Bank and the Bank of England have signed a memorandum of understanding on cooperation and exchange of information relating to the Clearing Corporation of India, which is a central counterparty that is regulated and supervised by the Reserve Bank. The MOU will enable the Bank of England to assess CCIL for recognition as a third country CCP, that is central counterparty, for UK-based banks to clear their transactions through CCIL. This MOU is based on the principles of mutual cooperation and trust among the regulators of both the countries, that is India and England. We hope the regulators of other jurisdictions also accept these principles. Financial stability, I would now like to just focus briefly on the aspect of financial stability. Financial stability, as we have stated before, is a public good. The Reserve Bank judiciously uses micro and macro-prudential tools to safeguard financial stability. The recent preemptive measures taken by the Reserve Bank in respect of banks and NBFCs were geared towards addressing potential risks and preserving the resilience of the financial sector. We do not wait for the house to catch fire and then act. Prudence at all times should be the guiding principle, should be the guiding philosophy, both for the regulators as well as the regulated entities. I now propose to turn to the external sector. In October this year, both merchandise exports and imports came back to the expansionary zone. Services exports remained buoyant during the second quarter of this year. India has remained the top remittance receiving country. The net balance under services and remittances is expected to partly offset India's current account deficit and keep it within the parameters of viability. On the financing side, foreign portfolio investment, that is FPI flows, have seen a significant turnaround during the current year, with net FPI inflows of US $24.9 billion up to December 6, as against net outflows in the preceding 2 years. Net foreign direct investment, that is FDI, on the other hand, moderated to US dollar 10.4 billion in April-October this year from US dollar 20.8 billion a year ago. Net inflows under external commercial borrowings, that is ECBs, and non-resident deposit accounts are, however, much higher than last year. India's external vulnerability indicators exhibit higher resilience in comparison with EME peers, as well as since the taper tantrum period. India's foreign exchange reserves stood at 604 billion US dollars as on 1st December 2023. We remain confident of meeting our external financial requirements comfortably. I would now like to announce certain additional measures. First one relates to review of regulatory framework for hedging of foreign exchange risks. The regulatory framework for foreign exchange derivative transactions was last reviewed in 2020. Based on market developments and feedback received from market participants, the extant regulatory framework for forex derivative transactions has been refined and consolidated under a single master direction. This will further deepen the forex derivatives market by enhancing operational efficiency and ease of access for the users. The next announcement relates to framework for connected lending. The extant guidelines on connected lending are limited in scope. It has been decided to come out with a unified regulatory framework on connected lending for all regulated entities of the Reserve Bank. This will further strengthen the pricing and management of credit by the regulated entities. The next announcement relates to regulatory framework for web aggregation of loan products. The Reserve Bank had introduced the regulatory framework for digital lending in August-September 2022. The digital lending ecosystem also comprises of services that aggregate loan offers from various lenders, and this is called web aggregation of loan products. Now, this is meant for the guidance of the customers. It enables the customers to decide which loan product to opt for. Several concerns relating to such web aggregation of loan products which harm consumers' interest have come to our notice. It has therefore been decided to lay down a regulatory framework for web aggregation of loan products. This is expected to result in enhanced customer centricity and transparency in digital lending. Next announcement relates to setting up of a fintech repository. Financial entities like banks and NBFCs in India are increasingly partnering with fintechs. For better understanding of developments in the fintech ecosystem and to support this sector, it is proposed to set up a fintech repository. This repository will be operationalized by the Reserve Bank Innovation Hub in April 2024 or earlier. Fintechs would be encouraged to provide relevant information voluntarily to this repository. The next announcement, there are two announcements relating to UPI. The first announcement relating to UPI is for enhancing the UPI transaction limit for specified categories. The limit for various categories of UPI transactions have been reviewed from time to time. It is now proposed to enhance the UPI transaction limit for payment to hospitals and educational institutions from rupees 1 lakh to rupees 5 lakh per transaction. This will help the consumers to make UPI payments of higher amounts for education and healthcare facilities, for education and healthcare purposes. The second announcement relating to UPI relates to, it relates to e-mandates for recurring online transactions. It's actually, it's a much broader announcement. It relates to e-mandates for recurring online transactions, and specifically, it focuses on enhancement of limit for specified categories. E-mandates for making of e-mandates for making payments of recurring nature have become popular among customers. Under this framework, an additional factor authentication is currently required for recurring transactions exceeding rupees 15,000. It is now proposed to enhance this limit to 1 lakh rupees per transaction for recurring payments for mutual fund subscriptions, insurance premium subscriptions, and credit card repayments. This measure will further accelerate the usage of e-mandates. So strictly speaking, this is not a part of UPI alone. I mean, it's a wider, it has got wider ramifications. And the last announcement that I have, it relates to establishment of a cloud facility for the financial sector in India. Banks and financial institutions are maintaining an ever-increasing volume of data. Many of them are utilizing the cloud facilities for this purpose. The Reserve Bank is working on establishing a cloud facility for the financial sector in India for this purpose. Such facility would enhance data security, integrity, and privacy. It would also facilitate better scalability and business continuity. The cloud facility is intended to be rolled out in a calibrated fashion over the medium term. I would now like to conclude. In a global economy clouded by uncertainties, monetary policy actions and communication can be a stabilizing force by anchoring the expectations of economic agents. Clarity and consistency in action and communication is a time-tested principle for effective monetary policy. Policymakers have to be mindful of the risk of being carried away by a few months of good data, or by the fact that CPI inflation has come within the target range. They have to be also mindful of the risk of over-tightening, especially when large structural changes, geopolitical and geoeconomic shifts are taking place. On top of this, they have to be watchful of the risks from new shocks that could hit the economy from anywhere, anytime. We have now reached a stage when every action has to be thought through even more carefully to ensure overall macroeconomic and financial stability, more so because the conditions ahead could be fickle. We have to remain vigilant and ready to act as per the evolving outlook. India is better placed to withstand the uncertainties compared to many other countries, as the Indian economy trades the path, let me repeat, as the Indian economy trades the path to a brighter future. I recall the wise words of Mahatma Gandhi, and I quote, "Progress is absolutely assured whenever there is an unalterable determination." Thank you. Namaskar.
This announcement. In fact, it is I'm Nandita Khemka, and let me introduce my co-anchor Stacey Pereira. We will be joined by a battery of guests to decode the announcement, and of course the liquidity measures, and of course the fact that we could look at a rate cut sometime next year. But just to recap the top 5 takeaways from the RBI policy announcement, so to say. Headline, repo rate unchanged at 6.5%. That was largely expected. Stance as well. There were some quarters that were, of the view that perhaps the RBI may look at tinkering with the stance, but that hasn't happened. So withdrawal of accommodation. In fact, 5 out of 6 members have voted in favor of this particular stance, given the fact that they want to align inflation to that 4% target. Aside of that, governor has obviously, highlighted the risks to inflation, because November and December, these are the 2 months, given the kind of increase that we have seen in food and pulses prices, inflation is once again expected to head towards that 6% mark. Aside of that, good surprise.
I think
GDP estimate,
right?
revised higher to 7%. Street was working with 6.7 to 6.8%. Perhaps this was a good, pleasant surprise given the fact that the governor has been fairly conservative when it comes to giving growth estimates, right? And inflation forecast, there were some people who were expecting that, perhaps the inflation forecast will be revised higher, given the fact that, next 2-3 months could see a rise in prices. So that hasn't happened. So growth forecast revised higher, inflation forecast retained for FY24 at 5.4%. That's the key takeaway, really from the RBI policy announcement. But Stacey, we have a battery of guests.
Absolutely. In fact, he's also made sure that he speaks about the different decisions that they've taken through the course, be it when it comes to the risk weightage that was added to the loans. He's spoken about that as well, and why it shouldn't be that the house catches fire and then they should be reacting. So very nice anecdote that he got in there. And we'll be asking all of our guests also. So joining us now is Mayuresh Joshi, the head of equity research at William O'Neill India, as well as Saugata Bhattacharya. He's an economist. Thank you so much, gentlemen, for giving us your time and speaking with us here at Money Control. Let me go to Saugata first and get a sense. This is already the 5th one in a row where status quo is maintained, and we already knew that this is perhaps what is going to come. Markets have already factored that in. We're not seeing much change there. We did touch that 21,000 levels there on the Nifty, which was what we were inching towards, we could say. But let's get back to the governor's speech and what we can really take away from them. He did, we wouldn't want to say too hawkish, but yes, that the way he's put it out is pretty much the same, and he is in that wait and watch mode. The big surprise, of course, being that nice increase seen in that GDP number, and that too coming in after what we saw in our Q2 number. So how are you looking at it, and what would be your highlights from this time's monetary policy? Saugata.
Thank you very much for having me on your show. So as you pointed out brilliantly, I think, you've covered it very well. So to my mind, the biggest surprise in this policy was the hike in the GDP forecast to 7%. It's significantly higher than even what we are expecting. So that's something. And then looking at the path of inflation that they have given for the first 3 quarters of next year, FY25, I think if these projections are correct, if the readings of inflation and growth, the trade-off between growth and inflation are correct as of this point in time, out goes any chance of any rate cut in the first 3 quarters at least of FY25, which is something that we were looking at, the possibility of a rate cut, the repo rate cut in, say, September or October of next year, 2024. So I think the inflation is not, as they say, inflation needs to come durably down to 4%, and Q3 FY25 inflation is projected at 4.7%. So no rate cuts. Actually, if growth, and particularly the growth rate, 6.4, 6.2 in FY25, if these actually go ahead with these levels, then there is no need for a rate cut as of this point in time. So obviously now, as he kept on emphasizing macroeconomic and financial sector stability, I think that's what will drive monetary policy going forward. Liquidity, as he mentioned, is in line with the monetary policy stance. So something I need to mention that financial conditions, which is something which is very important for a central bank, financial conditions have eased considerably, particularly in equities. Even bond yields have come off. Expectations of global rate cuts have started significantly. So financial conditions have eased, and in addition to the high growth rate, that obviates the need for a rate cut in FY25.
Right. Coming to you, Mayuresh, given the fact that, we've seen a very strong rally come in, 21,000, already on the charts. Do you think all the positives are already priced in? GDP revision of 50 basis points. Street was working with somewhere around 20 to 30 basis points. Do you think all these factors are already factored in? And would you see a case for consolidation going forward at these levels? Because the pace of the rally has really surprised everyone.
Morning, Nandita. Oh, absolutely. I think the mandate that has come politically and what RBI has revised in terms of the GDP forecast, as Saugata rightly pointed out, nobody was expecting a sharp revision to 7%, which is a huge positive. And obviously the impetus that has been laid to growth, both from central government policies and the RBI as a regulator acting in tandem with what the government is doing as far as liquidity is concerned and managing growth. I think that is what is getting reflected in terms of our macros very, very well. Ultimately, the markets will also move on micros, as you rightly pointed out, Nandita, and corporate earnings are expected to grow at a very decent pace. So for Nifty itself, the large expectations in terms of FY24 EPS is around 1100 odd rupees. Now, the cut in EPS estimates at the beginning of the year was with the perception of a hard landing in the West, specifically in the US, and sticky inflation in Europe. But with expectations of soft landing coming through, even the export side of earnings might not be hit as badly. Having said that, the expectations in terms of government capex over the next 5 years on infrastructure, on manufacturing, on construction is expected to continue at a very decent pace. And therefore, the upward revision in terms of real GDP, with inflation expected to remain at 4.5% and a dividend yield, would mean a normalized earnings return of 13.5% as far as the markets are concerned. And that is a very good sign as we head into the next financial year. So I think corporate earnings will ultimately grow at a decent pace over the next few years. Markets from a level perspective have probably factored in a large element. But what we have also seen historically, when election years come through, there is also this huge pre-election rally which builds up in anticipation of what might get announced and delivered in terms of both the interim budget and government policies over the next few years. So momentum from a level perspective can continue, but from a structural theme perspective, manufacturing, domestic capex, infra is where earnings can continue to grow very, very strongly over the next few years.
Right. Let me also bring on board, Achla Jitmalani, who's the economist at RBL Bank, and Jyoti Prakash Gadya, who's a director at Resurgent India. Let me come to you, Achla. Great to have you on the show. Given the fact that, we were expecting a status quo policy with no change in stance, growth revision, of course, surprised on the upside. But do you think there was a case to perhaps tinker with the inflation forecast as well? 6% is where economists expect inflation to head, at least for the next 2 months. In that sense, a slight upward tinkering with the inflation forecast was warranted. Would you say that? And what was your key takeaway from the governor's speech?
Hi, morning all. Thank you for having me on the show. Yes, I think there are certainly upside risks to inflation, as Governor mentioned, particularly emerging from the food basket. But at the August policy, they did hike their inflation forecast to about 5.4%. So seeing that bit of continuity on the inflation framework is a definite positive. And also it probably suggests that they are more confident of core inflation coming down, which would sort of negate the impact of higher food prices that we are seeing. And also probably as they headed into the policy, they did have some idea of how government intervention could possibly positively impact the inflation trajectory. For example, this morning we did see that the government has imposed certain restrictions on onion exports. So I guess this active supply side intervention in a way gives the MPC the comfort that such supply shocks would be addressed from the government. And also, I suppose it, as Governor mentioned, that they would want to anchor inflation expectations, given that they have hiked the third quarter inflation forecast to 5.6% from the earlier 5.4%, an expectation that as weather conditions ease, commodity prices globally soften, it could percolate into softer inflation prints in the fourth quarter, and therefore keeping the FY24 target at 5.4%. But having said that, probably a 20 to 30 basis point upward revision. More than that, I think the focus remains on how we bring in overall inflation levels to the medium-term target of 4%. And given that FY25 numbers are hovering around the 4.5 to 4.7% on average for the first 3 quarter numbers that they have given, is of course indicating that we would be on the path of disinflation.
Right. Well, let me also bring in Jyoti and ask him for how we've been talking a lot, and we've been seeing reactions also on the RBI's move of increasing that credit risk weightage and how that is really turning out. We've seen stocks reacting to it, of course, and today in the speech as well, Governor not mincing his words and saying that we are going to go out there and take whatever action is needed. How is this really going to turn around now? Because whatever we've seen pretty much most of these NBFCs taken on the chin post that move came in. Now he's continuing to say that that this is going to be our focus area. Is there more pain ahead for these NBFCs or for these kind of low ticket loans that we're going to see more action in that space?
I think so. RBI has now, whatever they have started doing is particularly pointing out towards a small macro policies that they have started working it out right now. They are taking into small pockets problems and then they are trying to resolve those issues. Same thing on the unsecured loan category. RBI was little worried about for this last 3-4 quarters. If you look into any of the governor's speech or any of the senior management speech, each and every constituent was a little bit worried about that unsecured loan part weightage. So that is why the RBI has came out with that the 25% of the extra risk weightage to be assigned to all the unsecured loan category. So what this generally means for the industry is this: in case all the AAA rated NBFCs where the risk weightage was around 20% earlier, now the risk weightage has increased to 45% right now. And the A-rated NBFCs, where the risk weightage is around 50% right now. And the difference in the fundraising for the AAA and the A was approximately around 200 basis point to 250 basis point. Now the cost of fund for the AAA rated NBFC and the A-rated NBFC, the gap is going to little bit narrow it down. So there are 2-3 things which will be repercussions of this macro policies. All the AAA rated NBFC, they may likely to borrow more from the bond market rather than directly borrowing in from the banking sector, because bank will think, sir, in case if I'm getting a same risk weightage asset at A also, where my margin is far more higher, then why I'm going to lend to a AAA rated NBFC? So we will see that way. Again, the pricing of the AAA rated NBFC, the cost of borrowing will definitely get an impact, maybe by 25 basis paisa to 30 basis point. And the flow of the money from AAA rated NBFC will start coming down to A rated NBFC. So this is the impact which we can see into the short-term phenomenon. And definitely the GDP to the debt portfolio, if you see, that is consistently on to a rise. And it is being backed by all the increase in the salaries, income and everything. But definitely in terms of that is a concern area, because all the consumption loan is getting increased. That is why you will see that every governor or the ministry is little bit worried about the private sector investments are not coming, or they are not coming up to that order, or the money is not going into the productive sector more. The money is going, or the borrowing money is going more into the consumption sector more. So just to curb that tendency of getting into that consumption mode, I think so this is a welcome step. And definitely the cost of borrowing, and this is the small pocket where there was some little concern area. I think so RBI has done a fantastic job in also addressing that gap, ma'am.
Right. So Jatin, speaking specifically